In this video, I'm going to show you the top 5 AI stocks that you should think about adding to your portfolio right away due to AI, quantum computing, and the overall landscape of technology going forward. These are the best overall stocks in my opinion, and I'm going to share them with you guys so you have the option to potentially grow alongside these stocks. However, first, before we get into today's video, huge announcement. Tomorrow, my free masterclass webinar returns, 6 p.m. Eastern Time, 3 p.m. Pacific. Tomorrow, Friday, June 6th. I hope to see you guys there. Very limited spots. The link's in the information box below. I'll be answering your questions. I'll have a Q&A, huge announcement, and I'll be teaching some exclusive strategies from my Discord, charting, analysis, and I want to show you why you're losing in the market and how you can turn those losses into wins. I look forward to seeing you tomorrow. So let's get started on today's video. I'm going to show you guys the top 5 AI stocks that you should be thinking about adding to your portfolio. And I went through a lot of the different tech stocks, and these are the ones that have the most promise. I have not really included quantum computing stocks, just AI and tech stocks in this video. So let's dive right in. If you enjoyed the video, give it a like. And if you guys want to see the top 5 quantum computing stocks for 2025, then leave a comment below and I will make that video for you. We're going to start off with number 5, and that is a stock called Nvidas, ticker symbol NVTS. Nvidas Semiconductor engages in the development of ultra-efficient gallium nitride GaN semiconductors. Its GaN power ICs integrate GaN power with drive control and protection to enable charging, power density, and energy savings for mobile consumer enterprises, e-mobility, and new energy markets. The company was founded in August of 2020. So looking at Nvidas, you can see that they have beaten earnings 3 out of the last 4 times. Next earning is August 18th. And of course, they don't have a price to earnings ratio because they are not essentially profitable. Their EPS is in the negative, not by much, but it is negative. So what we want to do is we want to look at their market capitalization, which is $1.16 billion. And we're going to divide that by their trailing 12-month revenue, which is $74 million. So we're going to do 1.16 billion divided by 74 million. And we get 15.6, which is pretty standard in the stock market to have a 15 to 20 price to sales ratio. But we also have to look at other factors. We look at the total revenue is pretty good. Pre-tax income's in the negative though. Operating income is in the negative. Net income negative. But the EBITDA is also in the negative, which is not good. So Nvidas has a lot of potential, but it's number 5 because of the fact that it's not profitable yet and because their numbers aren't strong enough to justify anything better than number 5 in this list. But there is a lot of future guidance on the table. Their assets cover liabilities, and they have $80 million in cash, negative $79.42 million. Actually, most recently is negative 68.25. And anytime you have a net number that is negative, essentially you have none of that, which means no debt. They have 70 million or just about 70 million in cash, which is strong. Assets cover liabilities. You can sustain a business that's not profitable as long as cash flow is coming in to keep the business afloat, but you won't find very many businesses long-term that are negative in cash flow without incurring lots of debt and loans and just getting themselves deeper and deeper in the hole. However, Nvidas has the potential with future guidance and analyst ratings to go up a lot. $6 is really not that expensive, but it's slightly overvalued, all things considered right now. However, if we look at future guidance, Nvidas has the potential to run a lot. And when we think about companies like AMD and Microsoft, and more specifically Intel and Nvidia, Nvidas has the potential to start gaining market share, become profitable, become bigger, more expensive, and grow. And essentially this stock at some point in the next 3 to 5 years could be $15 to $20 or even $30 and even more than that. So this stock could essentially be anywhere between 3 to 5x up to 10x, depending on if they become profitable, how soon they become profitable, a lot of factors. But at this price, it is very enticing, which is why I have brought this stock into the top 5 at number 5. Also has partnered with Nvidia for their upcoming Kyber data center power infrastructure. Entering the month, Nvidia has been a small designer of gallium nitride, like I said, GaN, and silicon carbide SiC chip designs. These niche chip designs have primarily targeted electric vehicles and electrified infrastructure, but given the recent downturns in these markets, Nvidia had seen its revenue go into reverse and its bottom line continuing to lose money, but there's a lot of potential coming up. In mid-May, Nvidia named Nvidas as key partner for Nvidia's upcoming Kyber data center infrastructure, which will be new architecture to support Rubin-based server racks beginning in 2027. While other power chip providers were also named, the fact that Nvidas was so small at just 350 million or so market cap at the time of the announcement caused a massive rally in the stock. Nvidas then used the opportunity to sell stock and bolster its balance sheet, extending its runway likely until the 2027 timeframe. So it's very risky at this point in time to invest in Nvidia, but it has the potential, especially partnering with Nvidia, that this could skyrocket the company just on that alone and continue to work with their niche chips that Nvidia may need more and more of going forward, which could bolster growth between both companies. The number 4 AI stock to add to your portfolio is Crowdstrike. Crowdstrike is a leading cybersecurity company specializing in endpoint protection and cloud security, and their Falcon platform offers a unified AI native approach to threat detection, prevention, and response across endpoints, workloads, and identities. Crowdstrike has actually partnered with the number 3 AI stock to add to your portfolio, which we will be getting to soon. But just so you know, number 3 is actually partnered with Crowdstrike. Looking at Crowdstrike, they have beat earnings consecutively. Next earnings is in September 2nd. June 3rd, they beat earnings, crushed as per usual. They missed on revenue very slightly, very slightly. And looking at market cap, they're 115 billion. We're going to go into financials, 115 billion divided by 4.14 billion right here. So when we look at calculator, we're going to be looking at 115 divided by 4. Price to sales 28, which is right in line with a lot of stocks in the stock market, actually better than Tesla. But still, the reason why they're at number 4 is because a lot of their growth has already happened. Look at the revenue, $4 billion a year, gross profit $3 billion. Now, if we look at operating income and pre-tax income and net income, all in the negative. Gross income and total revenue, gross profits are all good. And we look at EBITDA, they're in the negative 60 million. So Crowdstrike is starting to work its way down, and they have hit a little bit of a rough patch, but with AI and quantum going in the direction it is, Crowdstrike is likely to recover through all of this and grow much further. They also have a negative net debt, which means they have almost $4 billion in cash and enough assets to cover liabilities. And their cash flow trailing 12 month is $1 billion. So lots of healthy cash flow, very healthy balance sheet, and they are in the right sector providing a stellar service. So really it's just profits that are suffering at this point in time, but there are a lot of companies suffering in the AI space, and there's a lot of uncertainty. So we can't pin all of that on Crowdstrike at this particular point in time. But when we look at the future guidance, it's projected 474, which is still slightly higher than where it is now. Analyst ratings on Crowdstrike are between 480 and 540. However, with AI going the way it is, and Crowdstrike with a very powerful platform and very powerful services in AI and cybersecurity, it is likely that in the coming 3 to 5 years, we could see Crowdstrike double or triple. It's really dependent on AI's infrastructure and how things go with AI, quantum, and the overall tech space going forward. Let's not forget, it was nearly a year ago that Crowdstrike reached household name status following software glitches that caused possibly the largest IT outage ever. The cybersecurity firm's first quarter earnings report, posted this previous Tuesday, highlights its continued efforts to move past it. Crowdstrike posted an earnings of 73 cents a share, beating analyst estimates of 66 cents a share. Its revenue rose 20% year over year to 1.1 billion, a hair shy of Wall Street's consensus. The company posted annual recurring revenue of $4.44 billion, which is up 22%. For its second quarter, CrowdStrike expects sales between $1.14 billion and $1.15 billion, and adjusted earnings of $0.82 and adjusted earnings of 82 cents to 84 cents. That's compared to analyst expectations of $1.16 billion revenue and earnings of 81 cents, according to Fact Sheet. Investors were nonplussed, sending CrowdStrike shares, which have soared lately, down more than 6% after this report. Last year, CrowdStrike reported $60 million in costs related to its outages. In its latest earnings, the company reported another $39.7 million in outage costs. CrowdStrike has projected millions of dollars more tied to discounts the company has offered to customers. Despite costs still lingering, CrowdStrike shares have recovered, breaking record closing highs 3 times in the past week before Tuesday's drop after the bell. Despite costs still lingering, CrowdStrike shares have still recovered, breaking record closing highs 3 times in the past week before Tuesday's drop after the bell. The stock has more than doubled off the lows it had fell to last July, shortly after the outage. The number 3 top AI stock that you should be looking to add to your portfolio has utilized CrowdStrike's AI infrastructure security for their own AI infrastructure. And not only that, this specific company has surged over 200% in the past year, and their revenue has increased 420%, and they're expected to have a 200 to 400% growth in 2026 and 2027 while they reach profitability. And the only reason why they're not number 2 or number 1 is, well, you'll find out when we get to number 2 and number 1. But other than that, number 3 is none other than Coreweave. Coreweave actually utilizes CrowdStrike for their security. Let's dive in to find out exactly what Coreweave does. Coreweave is a cloud provider specializing in GPU accelerated computing, particularly for AI workloads. They offer cloud, platform, and software designed to handle large-scale, GPU-intensive tasks, making it ideal for AI developers and businesses needing to train and deploy AI models. Their platform is known for its flexible infrastructure and Kubernetes native architecture and the ability to access high-performance Nvidia GPUs. Coreweave focuses on providing access to Nvidia GPUs, allowing users to leverage them for compute-intensive tasks like AI model training and inference. They have developed a cloud platform specifically designed for AI workloads, offering features like Kubernetes native architecture and GPU accelerated computing. Coreweave's cloud infrastructure is designed to be flexible, allowing users to scale their compute resources as needed, whether they need more or less GPUs. They offer software that enables customers to monitor and control the performance of their hardware components, and Coreweave has strong partnership with Nvidia and has been recognized as an early adopter of their new GPUs, including the H100 and H200. And they focus on AI workloads. They primarily focused on serving the needs of AI developers and organizations, offering solutions for AI model training, inference, and other AI-related tasks. So looking at Coreweave, you can see they were on the market for only the last month and a half. And it would have been great to get in at $47 before it ran 3x, but we have to look at a few things here. And one is that they're not profitable as most recently. They're going to be expected to turn profitability somewhere in the new year of 2026. We have to look at their year to date, which is 253% since they've been on the market, but most importantly, $64 billion in market cap. And when we go to the financials, $64 billion, there is no trailing 12 month because of how new this company is on the market. However, when we add up quarter 1 2025 and quarter 4 2024 all the way back to Q1 24, we have 188, 747, and 981. So essentially, if we add 188 plus 747 plus 981, we have $1.91 billion. $1.91 billion trailing 12-month revenue, which means they have a price to sales of 0.5. Anything under 10 is good. Anything under 5 is stellar. When SoFi had a price to sales of 2, they skyrocketed to 6 with a 3x return. They're back around 4, and they still have plenty of room to grow. Different sectors, but very similar way we analyze potential growth. Price to sales basically analyzes a stock's market cap and the money they're bringing in to gauge a very fairly accurate representation of what the company is likely to be able to do or what their potential numbers are to be able to do in the future. And at 0.5, we can expect a stock like Coreweave, if they're to achieve their potential, that is, to achieve roughly a price to sales of around 8 to 10, which is right around where other stocks are in this sector. And if they achieve an 8 to 10, heck, even at 6 gives them a 12x. And at 12x, we could expect the price to eventually make it to $1,680, right around $700 to $1,000. More than certainly, we would get a forward split of 10 to 1, meaning you would end up getting a share price of around $100 and you would times your shares by 10. So if you had 100 shares at 1,000, well, you'd end up having 1,000 shares at $100. This is what typically happens when stocks go up really high. Surprisingly, Netflix has not done this yet. Walmart has done it. Nvidia has done it twice. And there are other stocks that have also done it. In fact, Nvidia has done it more than twice, I believe. But just offhand, this is what we are looking for potentially with Coreweave. This could potentially be a 6 to 8x return. So if you end up, let's say, buying 200 shares times $147, which is where the price, actually it's 131. There we go. $26,000. And then we times this, let's say by 8 in the next 5 years, you can turn $26,000 into $200,000 potentially. I mean, there's risks here, inherent risks. You have to be very careful about the risks because there's no telling if this would happen, but it looks like Coreweave has this potential based on their partnerships with Nvidia, the fact that they work with Crowdstrike for their overall security and the services they provide and the massive growth that they're seeing and the surge in growth, that potentially based on the sectors surrounding it and the price to sales, they could reach a 6 to 8x return. And this is a very big return. Even if it only 3x'd, you could turn 26,000 into 76,000 in the next 3 to 5 years, which still averages 100% per year. Even at 150% or at 100% over 3 to 5 years, it's still 20 to 30% a year, which is double what the S&P 500 delivers. The only reason why Coreweave didn't make number one is, well, of course, because number one and number two are a lot more profitable and, of course, more stable. And you're going to see when we get there. Let's look at the total revenue is very good. Pre-tax income is negative. Operating income negative. EBITDA is positive, which is good. So their balance sheet, they have enough assets to cover liabilities, but their debt isn't the greatest. $10 billion in debt is quite a bit. We look at cash flow. They are negative on cash flow, but EBITDA is positive. It's kind of hit or miss. There are inherent risks here, so be careful. And I teach that in my Discord. I teach it to my students, and I'll be teaching it in the webinar tomorrow, Friday, June 6th, 6 p.m. Eastern, 3 p.m. Pacific. You don't want to miss it. I'll be hosting a Q&A to answer your questions. Huge announcement. Also, the link is in the information box below. I'm going to show you why you're losing. I'm going to blow your mind on what it is you're missing on fundamentals, technicals, and how to make money in an up or down market, especially a volatile market. And if you want to make the profits you see on the screen and you want to grow your portfolio, whether you're new or whether you've been in the market for a while and you're losing money, you want to be at this webinar tomorrow, very limited spots. And just to give you guys a little bit of insight on how I teach my students how to trade, here's a quick clip of me in today's morning coaching call in the Discord, showing my students how to scalp and day trade on Tesla right after it had dropped. And before it had its big drop, we made 60% or near 60% returns in a 5-minute trade. Check out the clip.
If we can get this candle red down to here and it resists down in here on the 1 minute, there we go. There we go. See, just like I thought. Come on, come down to support. There we go. Come to Papa. If this candle breaks above here, then we're in a mini uptrend to up here. We're waiting for a break up here or a drop down here. If it breaks up here, we got to wait more. If it drops down here, we wait for a pullback up and we enter. I'm waiting for all the selling to stop, which is likely down here. See, told you. What did I tell you? It was going to go right back to red. See, it's going up now. If you took it, Derek, you're making money now. You see? You're going to make money, Derek. Get ready to get out. As soon as Tesla goes to 322, I would get out right there. Okay, so be careful. That's your max for right now. And this is your other. These are your two lines, Derek. You want to play these lines, okay?
Yeah.
It's resisting this line right here. What was your entry price? Like 320.78 or something?
Yeah, right when you said you're looking at that price, I saw that drop and I saw the punch up. I bought in then.
If the stock goes up to 322, you'll probably be like 30, 40%. And that's a good day trade. It's just quick and easy money. It's got to stay where it's at now or go above. Okay.
Yep. And that 200 EMA on a 1 minute candle is like a magnet. I swear, it touches a 200, bounces off it every time. If you can play 200 EMA on a 1 minute candle, you can make some money.
There you go. There you go. Told you. There we go. All right, get ready to get out, Derek. Yeah, you're probably 20% at this point, I'd imagine, right?
Yep, 20%.
There you 30%, 30, 40%. There you go. There you go. There you go.
Yeah, my alarms just went off.
Now I would get out now. I'd get out now. I would get out.
Yeah, I'm out.
There you go. High five, Derek. What did you get? 60%, 50? What was that?
Roughly about 40%.
There you go.
Number 2 AI stock that you should be adding to your portfolio comes as no surprise to anybody when they hear it, and that is Nvidia. Nvidia is pretty much the king of AI chips, computers, whether it be GPUs for gaming or GPUs for infrastructure, data, and quantum. Everything is built by Nvidia. In fact, the only reason why Nvidia is not number 1 on the list is because they have a complete and an entire control of market share in this sector or multiple sectors. And the only downside to that is when you reach the top of Mount Everest, there's really only one place you can potentially go if you're removed from this mountain in any shape or form, and that is down. Intentionally and not surprisingly, companies that have a massive market share or controlling market share only give up market share. Does this mean that Nvidia is worth less or will go down? No, it just means that the exponential growth will slow down somewhat. The days of Nvidia doubling and tripling consistently every earnings is over, but there's still lots of gas left in the tank. And like Dan Ives has said multiple times, we're at a 4 a.m. party and it's only 9 or 10 o'clock. Personally, I think it's midnight. There's still plenty of time left to run in this party, but the big and most expensive moves or the big events that are taking place at the party have already started happening, but you can still get in. And with Nvidia, they have pretty much the controlling share of AI tech GPU and hardware H100, H200 GPUs. For gaming, they also have the RTX 5080 and 5090s, which I have a 5090 and I have a couple of 4080s and I have a 4090 as well. Very good GPUs, very good AI and tech, and they're partnered with many different other AI companies and they have spread out across the globe. They are the leader. It does not get any better than this or any safer than this long term. There's a lot of volatility, but if you invest in AI and you invest in Nvidia, it's pretty safe to say that if you invest right now, no matter what caveats or pitfalls that may happen, I would say it's rather certain, not quite 100%, but pretty close to it, that if you invest in Nvidia now, in 3 or 5 years from now, it's going to be higher than it is right now. In fact, almost surely in 1 to 2 years, it'll be higher than it is now. Nvidia is the king. And the only reason why I didn't rank Nvidia number 1 is because they have the major market share and the growth has slowed down quite a bit. And number 3 is that number 1 is poised to 2 or 3x in the coming 2 to 3 years. And I'm not so sure if Nvidia can 2 to 3x in the next year or two. We'll see when we get to number 1, you'll find out exactly why Nvidia is number 2. When we look at Nvidia and we look at the 3.42 trillion market cap, they are not the biggest anymore. And I explained to you guys this would happen, and I'll show you who is number 1. None other than Microsoft. I told you guys Microsoft would be the very first American 4 trillion in tech, and that's exactly what is currently happening. They are approaching 3.5 trillion. Microsoft will be the king, and they'll be the first to reach this pinnacle. And I told everyone this on YouTube and my Discord several months ago. They were running to 500. If you guys go back and watch any of my YouTube videos from November to January, I called it. I told you Microsoft would run to 500. But that's not to say Nvidia is any slouch. This is all about Nvidia, not Microsoft. When we look at Nvidia and we see their current price, it is still a pretty decent bargain at 138 because the stock has reached as high as 155. There's still a $20 upside right now, and that's just where the stock could return to. That doesn't include all of the future growth. We look at 3.42 trillion. They already have a very good priced earnings, are pretty modest modest price to earnings at 45. Price to sales will gauge future growth at 3.42 trillion. We can look at their trailing 12 month at 148 billion. Let's divide this 3.42 trillion divided by 148.51 billion. Actually, we'll just do 148.51 billion like this. There we go. Price to sales of 23, which is right in line with most of the tech stocks. As you can see why Coreweave is so good of an investment, even though there's inherent risks there at number 3, because Coreweave has a price to sales of 0.5. So by taking that formula, not saying they'll ever reach what Nvidia has reached as far as price to sales and growth, but when you look at that number, when you divide 23 by 0.5, you get 46. If Coreweave was to 46x at 131, they'd reach $6,000 share price. I don't think that is feasible. I think Coreweave could triple or quadruple in 3 to 5 years, but I think that is a little much. We look at their earnings. Operating income is always stellar. Pre-tax income is very high and stellar. So is net income. EBITDA, very strong. Balance sheet has enough income and assets to cover liabilities easily. $44 billion in cash. They are the king for a reason. Cash flow is very high at $72 billion a year, $26 billion in the most recent quarter, showing 74% quarter-over-quarter growth, and consecutively 6 quarters in a row, actually 8 quarters in a row of growth, exponential growth. Nvidia still has it. They are still the king, and this is still something that you'll want to add to your portfolio, because we'll be looking back most likely 3 to 5 years down the road saying, wow, Nvidia is back at 1,000 again 5 years from now potentially, and I could have got in at 130 or 140 or 125. This isn't a stock that you're going to get into right now and make a lot of money instantly. This is not get rich quick. There's inherent risks. You have to be careful of all of this. However, with the growth potential and the way Nvidia is going, there's almost no doubt that in 3 to 5 years, this stock could double, triple, or even quadruple. And they've done it before. They've proven it before. So just know the risks, but understand that this is a very strong and much safer investment than the other plays, which is why it's number 2. But the reason why it's not number 1 is going to be self-explanatory. The number 1 AI stock to add to your portfolio is none other than Palantir. Palantir takes the number 1 spot away from Nvidia because of its potential growth, its Project Maven $500 million government contract. The fact that they have 50-50 split between commercial and government contracts says that even if geopolitical issues get out of control, they can rely on government contracts to survive, whereas a lot of other companies will not be able to do such a thing. They also have a big commercial sector, and they also have a big amount of profits, and 50% roughly of their income is commercial. So in the event that we keep going peacefully in the world with no geopolitical events, we can still rely on Palantir being profitable because of the amount of contracts and the growth that they have had over the previous 2 years. Alex Karp is a very smart CEO, and their AIP is second to none. This is pretty much the best AI stock you can get into. Right now, it is slightly overvalued, but if you look at potential future growth in the coming 1 to 3 years, well, then it's priced accordingly. However, I would recommend looking for a dip, which we're currently in the middle of. The stock has dropped from 133 to 125 down to 118, and we're starting to approach a nice area where you could sell puts to get in and acquire shares. In my personal opinion, I think at the current value and what's going on with Palantir, they're worth more or less between $70 and $90. If you account for future guidance, even $100 is a pretty decent bargain. 118 to 130 is a little on the high side now that we've pulled back to 118. If this stock pulls back to 115 or 110, I would start looking to add some shares. I'm running my 33-10 rule, which I am going to be going over and teaching in the webinar tomorrow, June 6th, 6 p.m. Eastern Time, 3 p.m. Pacific. And I teach this to my Discord, the 33-10 rule. I am going to be averaging out 3 times, and for every 3 times, it's 2 on the dip and 1 on the high. And I really, truly believe that if you can get shares between 80 and 110, that's the good buying range right now, and the lower, the better, but there's no telling if Palantir is going going to drop that low again. Right now, it's already dipped down to 118, 119 and resisting heavily. And it reached a high, like I said, recently of 135. So anywhere in the 100 to 110 range would be pretty darn good. And when we look at the future potential for Palantir and their AIP and the contracts that they continue to add and their exponential growth, Palantir very likely will 2x or 3x in the next 3 years. I told my students and everyone in Discord and here on YouTube to buy Palantir when it was $15 this time last year. And I told everyone back in October to buy it when it was $50 and $60 and it ran to $135. If you had put $50,000 into Palantir when it was 15, well, I would just like to say that you would pretty much have a 9x return, which means you would turn 50 grand into $500,000. In fact, one of my students, Josh, has actually done such with Palantir. He grew his account from 300,000 to over 850,000 in a matter of 5 months from July last year up until November of 2024 last year. So it can be done. I want to show you guys on the charts what we're looking at with Palantir. Looking at their market cap of 282 billion, we're going to divide their financials in like we have previously, 3.12 billion. So we're going to open up calculator and divide 282.98. Actually, just do 283 divided by 3.2 to make it even is an 88 price to sales, which is high. Price to earnings is also high. But what is quite interesting is their trailing 12 month and their quarter over quarter growth, total revenue, gross profits, operating income, pre-tax income, all really good. Net income is also very good. When we look at their EBITDA, yet again, no surprise, it's good. The balance sheet is also very good. They have more than enough to cover liabilities and cover the company, and they have a net debt of negative 5.19 billion. And this is 5.19, almost 5.2 billion in cash. And then we look at cash flow. Free cash flow is 300, 457, 415, 141 million per quarter in cash flow. Palantir has pulled back a little bit in free cash flow in the most recent quarter, but this honestly is the stock to really look at for number one. And when we look at this stock in particular, Palantir, really my AVP, which is a strategy I'll be teaching at the webinar tomorrow. You don't want to miss it. This is a strategy that I created that's very powerful based on dark pool data and hedge fund data. When we look at AVP, anywhere between the bottom and top is where you'd really want to be buying in the average, and the top of the average is 95. Palantir is pulling back. So in order to get a 95 average, we would need to be selling 105 puts a few weeks out or more, but we could get a very nice entry. And if we go over and look at Palantir, you can see, looking at Palantir, if we were to sell puts going out to June 27th, we could sell 105 puts for about $225. If we were to get assigned, an average cost would be $102.50. So that's not too bad. If we go out to July 3rd, we can look at those same 105 puts, and they will give us almost $300, giving us an average cost of 102. If we sell the 100, we have an average cost of 98. Me personally would be selling 1 month puts at $100, because if we keep doing this, even if we get assigned on these puts the first time, the second, third, and fourth time, we won't. And if we just keep selling puts, that put premium is going to come off of your total cost. So if you sell, let's say, 2 puts on Palantir at $200 and you get assigned on both, your average cost is 98 times 200. You have 400 shares with total investment of 19,600. If you sell 2 puts a month for, let's say, 6 months, that is going to collect you about $2,400, which now, if you haven't been assigned, you can take that off your $19,000 investment, which means at the end of 6 months, you could potentially be looking at an average cost of $86. If you sell puts in the right way, at the right strike, throughout the coming months, even after you've been assigned once or twice, you can actually get your average cost in Palantir down potentially you could anywhere between $80 and $90. And if you can acquire shares like this on Palantir, it is an absolute win, because the stock, when it does run, you'll have more shares at a lower cost. And this is something that I teach in Discord to my students and in the coaching calls But if you want to learn some of this, tomorrow at the webinar, I will be teaching it. Very powerful on how you can utilize put options while buying shares over time, even after you've been assigned, to keep selling put options to lower your cost on the stock. Palantir is the #1 tech stock still to buy. Even though the price is high right now, we're waiting for it to pull back like it is and selling put options a month out down here so that if it does dip and we get assigned, we're getting the stock much cheaper. If we don't get assigned on these puts and the stock starts to come back up, you can buy the stock up here and this will expire worthless and you can take these premiums off the stock price up here. So if you end up paying 120, but you collected 2 puts down here at 200, well, then your average is 118 for your shares up here. And you can utilize puts to lower your cost. And you can also sell covered calls to generate even more premium while building your position on Palantir. I look forward to seeing you guys at the webinar tomorrow, 6 p.m. Eastern, 3 p.m. Pacific, Friday, June 6th, which is tomorrow. Limited spots remain. Link below. I'm going to show you everything you need to know in the stock market. I'm going to show you why you're losing in the stock market and how to turn those losses into wins. And we're going to go over some dark pool data and my very custom strategies I designed off dark pool data and hedge fund strategies. And look forward to seeing you there tomorrow. Take care of yourselves, fam. I will see you on the next upload and at the webinar tomorrow.